friends, how are you? Igor Pechkovsky is here, Windermere Bellevue Comments. In today's video, we have September real estate market update, the Eastside Seattle. There are a lot of news, there are a lot of noise out there. Interest rates just a couple of days ago got cut by 0.5%. How does that influence the mortgage rate? What's going to happen? We'll try to look into a little bit of a future in the next 5 to 10 minutes. Before we do so, I'll tell you all about where the market is, where the numbers are. So please make sure to like this video, subscribe to this channel, share it with friends. Let us know in comments on how we're doing and call us with any more questions. Without overdue, let's do this. Let's start with my favorite, the East Side. I'm located and live in Bellevue. Obviously, we all are in Seattle, greater metropolitan area, but the East Side is something where the action is. The East Side currently beats Seattle by all the metrics so far. Just slightly different markets. There are different reasons for it. There is a little bit different of existence of inventory in both markets. The East Side doesn't have the townhome influence as much as Seattle has on its all numbers. But still, let's look into it. The inventory on the East Side, 1.4 months. We are in the second half of the year. Second half of the year is usually slower than what the first half of the year would be. January till about June, this is the equity gaining months for the market, versus the second half of the year, it usually slows down. It's a bit more buyer's market from perspective. It's all seller's market, but buyers do have a little bit more breathing room, a little bit more inventory, and 1.4 months of inventory is what that inventory is. So the interesting slide, the median price is 1.55 million. In May, at the peak of this year's market, we were at 1.7 million on the purchase price on the median. So we had dropped 150K from the beginning of the year till now, but we're still up 7% year over year, which is extremely significant. Where the market will go from there, we'll see, but those are the numbers. The market is, as I say, more buyer friendly in the second half of the year. And the proof of that, over asking, we have at 39% for the last months. 39% of homes sold over asking. Busier, as you see, comparing to August of 2023, but a little bit slower than the last months. And if you look at the graph, which I call it my special graph of percentage of above sold listings to the list price, as you see, we are in 2024, which is bright blue. Throughout those years, the second half, it relatively just slows down. And 2022 is an example where it was near, only 10% that sold over asking. So those are the numbers, good numbers, fantastic numbers. If you're a buyer, it's getting a little bit more affordable. The median price is dropping. The interest rates are dropping on the East Side as well as everywhere else. Let's look into Seattle. Okay, my friends, so let's talk about Seattle. Seattle is unique in its nature. So some 4 years ago, we had a upzone where the code for buildings in many urban neighborhoods had been upzoned. You've seen a lot of construction where you tear down one home and build 4 townhomes. They are pretty much everywhere. On the East Side, depending on the area, it doesn't really exist. Kirkland has something similar. Bellevue doesn't. Redmond is its own little kingdom. But Seattle does. So in many areas, the inventory today, as you see, is right at 2 months of inventory. 2 months is great, meaning that there are a lot of options in Seattle to choose from. In some of the areas specifically, the inventory is 3 to even 4 months of inventory, which is a balanced market. So seller's market is 1 to 3 months of inventory. Balance is between 3 and 5 plus is buyer's market. We haven't had a buyer's market since 1999 in Seattle metro area, but balance is pretty darn great. It means that it takes 3 to 4 months for the inventory to sell, meaning you have plenty of options to choose from. Hooray, right? We all wanted it, right? To have more options to choose from. But On average, this is 2 months of inventory for the last months for Seattle, meaning that the median price is right around 930,000. So it's been pretty darn stable, right around 900K, still 3% higher than the last year. So that's good news. I mean, Seattle is doing, as you see, from 2015, it's just a gradual line of growth. There is still growth, and it should be like that. It shouldn't be insane, 20% up year over year. That's stupid, but Seattle is doing just fine. So over asking, we have a 31%. Right at 31%, as I just mentioned, slows down second half of the year, but still, if you're the buyer, what home do you want to buy? The best one. Well, the best one, there is still 31% chance would sell for over asking. That's just how that works. And another one, if you look year over year of comparison, just like the slide that we just showed for Bellevue, second half of the year, again, we're bright blue line at 2024. Usually that market slows down, and that provides the opportunity for the buyers to pull the trigger on and to find something, good deal before the year goes into the first half of the year, which it goes like that. All right, and last but not least, the Snohomish County. I always like to look at it because the east side and Seattle is getting expensive, and a lot of times folks move north. So Snohomish County, we are at 1.2 months of inventory, so definitely a lot less inventory than in Seattle, all right? But 1.2 months seems to be pretty stable over the last couple of years at around this time. Over asking is at 32%, meaning, there are 32% of homes that would sell over asking, and those are the homes that buyers would want to buy. So that's that. And we have the median price right around 780,000, which has been stable. It's been there for a while like that, but it's still 7% higher year over year, which is a lot. Meaning the market is back, even with those interest rates. So let's talk about the interest rates. My friends, interest rates. I'm not the person that sat and waited for these cuts for a long time. It happened. A couple of days ago, we did have a Federal Reserve rate cut in the rate by 0.5%. What does it mean for mortgages, you'd ask me? Right this second, it doesn't mean much because the mortgage rates had dropped from its height. A year ago, they were a little bit over 7% around this time. Think about it, 7% is really high. Today, they are in low 6 or right at 6, or in some cases under 6, depending on who you ask and depending on your DTIs and credit scores and all of it. Let's just call it 6%. So they're already lower. They've already been priced with the expectation of these cuts that we just got a few days ago. What it means that if the Fed wouldn't cut the rates or would have cut it by only 0.25%, the mortgage rate had a really high chance to go up, actually, not backwards. So the rate's gonna stay right around 6, but there is an expectation that they're gonna continue to cut, and they should. I'm not here to dive into economics. I have other businesses where we have, business financing at 11%, and that's completely different story. So what happens when rates are being lowered, which let's say they go to another 5.5% probably by the beginning of the year? Well, that makes the mode of buying better, right? It makes more folks afford more real estate, which usually puts pressure on real estate. So my advice to you, don't wait. Just look around and see what can you afford today. Today we have more inventory, which is great, more options for you to choose from. Today we already have a little bit better interest rates, and today we still don't have as much of competition as what I believe would happen in the first half of the next year, assuming we get more cuts. So just talk to your lender, reach out to us, let us know what you think of this video. Please share it with your friends. We try to be as transparent, as straightforward as we always been and will be. I hope you liked it. Let us know. I appreciate it. Igor Pechkovsky, Windermere Bellevue Comments. Talk to you later.